I think narratives are one of the most misunderstood things in macro.
Yeah.
I didn't really realize how these narrative shifts are so powerful. I try and step back and look at when the narrative is overly intense.
Hey everyone, and welcome back to Crypto Alpha. Today we're summarizing the recent interview with Alex Gurovich, a hedge fund manager with a background in mathematics, who shares his macro and future outlooks with host Raoul Pal. The conversation explores 5 key processes currently influencing markets, including the business cycle, fiscal policy shifts, demographic trends, the political landscape, and the impact of technological singularity, particularly the rapid advancement of artificial intelligence, AI. Gurevich offers his perspective on investment opportunities in the current environment, favoring long-duration bonds and the Japanese yen, while expressing caution about equities. The latter half of the discussion focuses heavily on the potential implications of AI, from its impact on job markets and economic structures to its potential as a deflationary force, with both participants agreeing on the unprecedented scale and speed of AI development. Before we jump into the interview, please don't forget to like the video and subscribe to the channel. If you listen right through to the end, please leave your feedback on what you would like to hear about next from the crypto and AI space. Now let's jump straight into a key part of the interview.
Over any long period of time, it's undervalued, right? Whenever you look back at long enough horizon, stock market was always undervalued, right?
At every point, yeah.
At every point of history, stock market was undervalued so far. And that'll probably remain the case.
But why don't people see that? It's a very simple thing. If the stock market's gone up all of the time, and then it's always historically been undervalued, but people just don't understand this.
Well, the thing is, even having said that, it is still might be true that under certain conditions, when stock market is relatively overvalued, the expectation over the next decade of stock market might be just based on historical pattern, the expectation might be diminished.
Yeah.
So there is nothing wrong with being short stock market if you believe that the expectation for the next 1 year, 2 year, or 5 years negative, right? Whatever your strategy is, whatever your way of valuation is, it just there are times on stock. What I think is the problem is that what I don't see why people are not basically not buying the big dips, right? Why people not buying in 2020 or 2008, 2009, that is the real big problem with most people having. Not owning it now, not owning it in 2018.
They seem to have, what I've noticed, Alex, is they seem to have an anchoring bias to 1929 and 1930, and they can't shake it. I had it in 2008. I thought there's going to be another leg lower. We're going to go down the kind of 80%. But most people anchor on that, which was a once in history event. And so every time it goes down, they still think it can halve again and halve again.
Yeah, I think every time the stock market goes down, they create a narrative why things are going to be really bad for a long time.
Yes.
There is always a narrative explaining the current situation. And it is interesting. It's the same thing actually with bonds.
Alex Gurovich and Raoul go on to agree that there isn't a specific timeline provided for how long it will take for the market to fully recover. However, their discussion highlights the cyclical nature of markets and the factors that typically lead to a rebound after a downturn. Within the context of the business cycle, a period of weaker stock market performance is expected during times of tighter liquidity. Eventually, central banks are expected to start adding liquidity, even if they initially drag their feet. This is described as something that always happens and is unavoidable. The addition of liquidity by central banks is seen as the factor that leads to a rebound on the stock market after a significant slump, and a rebound on asset prices. Alex believes that while the stock market has historically always been undervalued over a sufficiently long horizon, there are times when it is relatively overvalued, and the expectation for the next decade might be diminished. He feels the odds are skewed towards the stock market being significantly lower at some point in the next 2 years. He notes that after a strong run, the market historically goes back to test previous breakout points, which happens every single time, triggered by various events. He also states that the one greatest opportunity for investors lies in buying the stock market at the bottoms during crises rather than timing short positions. This implies that periods of significant downturn are viewed as opportunities for long-term investors. The pair of macro investors do not provide a precise date for when a potential future low point might occur or how long the subsequent recovery would last, but they outline the pattern where a slump is followed by the injection of liquidity and a resulting rebound. So there you have it. What do you think is coming next? Do you think the market will recover in 1 month, 3 months, 6 months, or is this it? Are we now in a bear market? Let us know your thoughts in the comment section below. We read and reply to every comment. Thanks for watching, and we'll see you again next time on Crypto Alpha.